Now, let's move on to Chapter 3, Cost Volume Profit Analysis. The basic form of cost volume profit analysis is to calculate the break-even point. How many units do I need to sell so that at least I have no net loss? What are my revenue and cost going to be? Of course, in this case, revenue and cost will be the same because you're breaking even. In more advanced applications, the CVP analysis can help you break down the criteria you have to meet in order to reach a specific profit target. How many units do I need to sell to reach my target operating income of $100,000? What are my revenue and costs going to be now in this case? Let's first go through some terms and concepts. Contribution margin. Contribution margin is the amount for which sales revenue exceeds variable cost. Sales revenue minus variable cost. It can be in the form of total contribution margin or contribution margin per unit. Contribution margin ratio / percentage. It's the total contribution margin divided by total sales, or unit contribution margin divided by unit selling price. Gross profit, sometimes also called gross margin, the amount for which sales revenue exceeds cost of goods sold. Margin of safety, the amount for which total projected sales revenue exceeds the break-even sales revenue. It can be expressed in absolute dollar amount, it can be expressed in percentages, margin of safety in sales divided by total sales, and it can also be expressed in units of goods sold. Degree of operating leverage, the extent to which the cost function is made up of fixed cost. High degree of operating leverage means that there is a high proportion of fixed cost. Companies with high degree of operating leverage face faster falling profits when sales drop, but enjoy profits that rise more quickly when sales increase. So it's kind of like a leverage. Percentage increase in sales times degree of operating leverage equals percentage increase in net operating income. The degree of operating leverage can be calculated in 3 ways. Contribution margin divided by net operating income, fixed costs divided by earnings before tax, altogether plus 1, or 1 over margin of safety percentage. Now let's go through one numerical example for Chapter 3. Lenovo can sell one ThinkPad T430 laptop for $1,000. The variable cost to one ThinkPad T430 is $300. Total fixed costs incurred for producing ThinkPad T430s are $400,000. For the ThinkPad T430 line, Lenovo is expecting an after-tax income of $1 million. The corporate tax rate for Lenovo is 40%. Question A. What are the break-even revenue and units? Question B. What are the target income revenue and units? C. What is the margin of safety? D. What is the degree of operating leverage? E. Verify that the degree of operating leverage accurately predicts the percentage increase in operating income from the percentage increase in sales. So, first solve A. The break-even equation is this. Fixed cost divided by contribution margin per unit equals to break-even units. So fixed costs are $400,000. Contribution margin per unit is the selling price per unit minus the variable cost per unit. So altogether, the break-even units is equal to 571.43. if we round it up, we get 572 units. We round up in this case because we can't have units, we can't have portions of units, and if we round it down like how we usually do in mathematics, we won't break even, so we'll have to round it up. Now, let me kind of explain why this break-even equation works. Fixed cost divided by contribution margin per unit. So the contribution margin itself already accounted for the variable cost. Remember, the contribution margin is the revenue minus the variable cost. So now the revenue is already covering the variable cost. Now, in order to break even, we just need the revenue to cover the entire fixed cost. So we're saying 1 unit can give us $700 in contribution margin for us to cover solely the fixed cost. How many units do we need to cover all of the fixed costs? That is how this equation is derived. Now, to calculate the break-even sales using the rounded number, $1,000, because one computer sells for $1,000. This much dollar amount in sales. So these are your answers. Now, question B is asking us, what are the target income revenue in units? So Lenovo has an after-tax income of $1 million. But this is after tax. We need to figure out what the before tax income is. So assume before tax income is X. So that means X times 1 minus the tax rate equals the after tax income. And when we solve this equation, X equals to roughly 166,667 dollars. This is the before tax income needed. Now, the operating income. So in this case, we will modify the original equation a bit. Remember, the original equation, the break-even equation, is fixed cost divided by contribution margin per unit. Now in this case, for the numerator, we'll add the operating income, which is this number right here. The reason why this works is because I just explained that the contribution margin is already, when we arrive at the contribution margin number, we are already accounted for the variable cost. Now we just need this number to cover the fixed cost in order to break even. And then after we break even, we need to cover all the operating income. So that's why we add operating income here on top of this on the numerator. Now, if we write out this equation, put the numbers in, 400,000 plus the operating income of 1666667 divided by still 700. This equals to 2952.38. Again, because this is real life, we have to round it up to 2953. So this is your target operating income unit. Now we have the unit. We can calculate the target operating income revenue, which is this number times 1,000, which equals 2953000. This is your target operating income revenue. Now question C asks, what is the margin of safety? Remember, in the concept section, I said that the margin of safety is the actual or expected revenue minus the break-even revenue. So in this case, the target operating income revenue, which is our expected revenue, minus the break-even revenue equals so this is the absolute amount in the safety of margin. The percentage amount is this. Margin of safety in absolute amount divided by expected total revenue. This equals roughly 80.63%. Question D, operating leverage. So to calculate operating leverage, there are three methods. One of them is total contribution margin divided by net operating income. The second one is fixed cost divided by earnings before tax altogether plus 1. Third one is 1 divided by the margin of safety percentage. I will show you the calculation with all three methods just to show you that all three will give you the same answer. And for the degree of operating leverage, it actually changes with regards to your sales. So right now, we will set our sales situation to the target income revenue. So the sales in this case is the one to reach our target revenue. So contribution margin divided by net operating income. In this case, $700, that's contribution margin per unit times the sales units divided by net operating income, which is 1,666,667, which equals 1.24. The second method is fixed cost divided by earnings before tax. This number is going to be the same as the net operating income number. It's just another way of calling it all together plus 1. So this equals to $400,000 divided by 1,666,667 altogether plus 1. This number also equals to 1.24. Now the third method is 1 divided by margin of safety percentage. And this equals 1 divided by margin of safety percentage. It also equals to 1.24. So because all the numbers equal, it proves that we have done the right calculation. Now, question E says, verify that the degree of operating leverage accurately predicts the percentage increase in operating income from the percentage increase in sales. So first, let's write out the equation. The equation is percentage increase in sales times the degree of operating leverage equals the percentage increase in your operating income. Alright, so we know that this is 1.24, and if we assume the percentage increase in sales is 10%, so 10% times 1.24, it should give us a 12.4% increase in operating income. So now the equation is set out like this. Let's verify this. Now remember, this 10% increase in sales happens on top of our target income revenue. So our target income revenue is 2,953,000. If there's a 10% increase in sales, we times it by 1.1 equals 3,248,300. Now, the units sold will also increase by 10%. Which equals 3,248.3. Now, because this is a proof question, let's just keep everything accurate. I'm not going to round this up. So if I don't round this number up, I can't round this number up. Because it's only proof, we would just like to see the mathematics behind it. So that's that. Now, the variable cost, total variable cost per unit will be 3,248.3 times 300, which equals 9,744,90. Fixed cost will still be the same. Now our operating income equals our projected revenue, the new one, minus the new variable cost, minus the fixed cost, which is going to be the same as before. And this equals 1,873,810. And if we divide this number by 1.124, we get, let me erase this whole thing and redo it on a new clean sheet. If we divide this number, the new operating income number that we got, by 1.124, we get 166,790.75 to be almost exact. Now this number should equal to 1666667 because we want to verify this, but it doesn't equal to that because not exactly because of rounding. Because remember, I rounded the sales unit from 2952, so 2952.38. I rounded it up to 2953, and I've also done some other rounding in some other process, so that's why this number doesn't equal to this number exactly, but This is the verification process. This is the proof, and this is close enough. If you get asked on this question, if you follow my step, you will get the full marks. You should get the full marks for this step because you should not be penalized for rounding. And if you want to be exact, because this is a mathematical proof, use exact numbers for all of your numbers. So, but because I use the rounded numbers for the purpose of illustration, this number is not exact. But the process that I have just done is adequate for the proof.